Hello, everyone. We would like to start by thanking Rotman Net Impact, Leasing Institute, and RBC for giving us this opportunity. We're going to present our Net Zero 2032 portfolio. Our team is the Impact Group, and it is formed by Metred Kaur, Marcela Castillo, Andres Rodriguez, and Rafael Rodriguez. So we want to start with a brief summary of our 4 stages to develop our proposal. So let's check the COP26 targets. First, the ambitious emission reduction by 2030 and the securing net zero by 2050. Second, mobilize finance with financial institutions ensuring that public and private sectors achieve net zero goal. Third, protecting and restoring ecosystems. And finally, working all together to accelerate action to tackle the climate crisis. So how all of this is going to apply to the sustainable finance perspective with 3 core things. First, increase sustainable investment standards. Second, manage sustainability related risk for the financial industry. Third, enable the shift of investment from unsustainable to sustainable economic activities in investment portfolios. With all of this background in mind, we proceed to analyze the current portfolio of the customer, Canadian University, and we found the following performance metric: a carbon intensity of 131,284 tons of carbon emissions per year, a Sharpe ratio of 0.51, and a standard deviation of returns of 8.35%, and the return before taxes of 5.34%. Furthermore, we found more indicators of our current portfolio: a geographic breakdown of 63% in Canada, 19% in United States, and 20% in other regions. And the principal industry breakdown are 29% in government, 19% in financial services, and 9% in industrial and energy industries. So now Marcela will present you our approach.
Thank you, Rafael. So we are focusing in these 3 approaches for a sustainable portfolio: the MSCI ESG fund rating, the weighted average carbon intensity, and the mission and vision from companies to 2032. Our first approach is the ESG fund rating, which is a metric of companies according to their exposure to industry, material, ESG risk, and their ability to manage those risks relative to their peers. This rating goes from CCC to AAA. Our approach is to focus only on those who have at least AA as rating. So having said that, we are going to search leading ESG stocks, funds, and projects. In this case, we're focusing on the leaders in this industry, those companies who manage the most significant ESG risk and opportunities. Our second approach is the weighted average carbon intensity. These metrics indicate a portfolio exposure to potential climate change and related risk to other portfolios. In this case, we're going to search stocks, funds, and projects with lowest tons of carbon dioxide emission, and we only consider those with equal or less weighted average carbon intensity of 134.6 tons of CO2 per $1 million sales. And we are using this number because it's the average of North America. Our third approach is the mission and vision of the companies they have for the next 10 years. We know that net zero target for 2032 is a really ambitious goal. That's why we're going to focus only on those companies that have this mission and vision that are aligned with our goals. Having said that, now we present how we are going to build our portfolio, the Net Zero 2032 portfolio. First, we try to make it as more diverse as we can. We are looking for this diversification across risk factors, geographies, industries, and asset classes. Second, the emissions. We're looking for securities with a low carbon intensity, and also we are going to look for carbon offsets to reach our net zero target. Then we're going to target we are going to look for a target return of 6.5% with a minimum volatility and 6% of portfolio allocated on active investments in stocks in Canada. And finally, we're going to search for those companies that are screen-based on ESG ratings, weighted average carbon intensity, and mission and vision for the next 10 years. Now, Andres is going to present the proposal.
Thank you, Marcela. So with that methodology in mind, we built this portfolio that we're presenting here. So as mentioned before, we took the 6.5% return, target return for the client, and we minimized volatility. And we try to build a portfolio that is diversified across sectors, across geographies, across different asset classes, and also risk factors. And the results are shown here. So 34% goes to fixed income, 54% to Canadian, US, and global equities, 6% to Canadian stocks, which are going to be part of an active play that we're planning to have within the portfolio, and 6% to alternative investments. The carbon intensity of this portfolio is around 100,000 tons of CO2 emissions per year, which compares favorably to what the client have right now, which is 130,000 tons of CO2 per year. Going to the next slide, we see a back testing that we perform for our portfolio and for the client's existing portfolio from January 2021 to February 2022. And on the right hand, you can see how 100K invested in these two portfolios would have behaved over that time period. And it's interesting to see that we're having lower returns, but this is also compensated by a lower standard deviation. So overall, we think that our portfolio is well balanced in terms of risk and return. Now going to the next slide, here we are presenting a factor regression. So we're going to highlight each of the columns that have a statistically significant coefficients. The first one is the market risk. As you can see, there are, like both portfolios, our proposal and the client's current existing portfolio have a very similar exposure to market risk. Next, moving to small caps, we see that only our portfolio has a statistically significant exposure to small caps, and that's going to enhance returns. And third, moving to the value size, we see that both our portfolio and the client's existing portfolio have a value play. Next, here we're showing some stats of the portfolio. So asset breakdown, we already covered that. Next one is geographic breakdown. Most of it is concentrated in Canada, especially because most of our fixed income is in Canada. And the rest is United States, 17%, and other regions, 4%. When it comes to industry breakdown, the Canadian government is the largest exposure, also because of the fixed income part of our portfolio. And all other industries, individual industries, have less than 21% of global exposure in our portfolio. So we're fine on that. Next, we're doing a zoom on the fixed income part of our portfolio. So fixed income securities were selected based on a screening that we did as per ESG index standards that are contained in the Bloomberg MSCI Canadian Aggregate ESG Focus Index. These securities have low carbon intensity, strong credit rating, are highly diversified across issuers, and they have an attractive yield of around 2.2% with a moderate duration of around 7 years. You can see in the credit rating breakdown that most of it is concentrated in AAA and AA, and this part of the fixed income all contributes to around 45,499 tons of CO2 per year, which is a little bit less than half of what the whole portfolio is producing in terms of CO2. Now, in terms of the stock portfolio, you see here that we selected a diversified exposure of low carbon and ESG screen companies across Canada, the US, and the world. And these stocks are highly diversified across issuer, across industry, geography, market cap. And as I mentioned before, these stocks have a tilt towards value and small caps. The global emissions of this part of the portfolio, of the stock part, is around 49,792 tons of CO2 per year. And this is roughly like half of the portfolio's CO2 emissions. And overall, like we have here some stats. So price to earnings of 20, price to book of 2.6, and more than 2,200 holdings. In the next slide, I'll pass it to Kudrat for talking about active investment. Over to you.
Thank you, Andres. So starting with the active investments, we invested in 6 funds, 6 stocks, and we made sure that they were 100% Canadian stocks. Also, these stocks were all investing in renewable energy, sources like solar and power for power generation. And these companies were either building, operating, or developing renewable energy resources. Then moving on to the carbon intensity, as we've already discussed the MSCI index, we made sure that all the stocks that we had in our portfolio adhered to the metrics set by them. We also truly believe that Canada has a strong commitment and support for clean energy innovation. And given the low costs here for R&D and skilled workforce, we think that there's a great potential for all these stocks within our portfolio. Moving on to alternate investments, we decided to go with a real estate investment trust. We chose Vornado Realty Trust, which is one of the largest publicly held real estate investment trusts in the United States. They invest primarily in office spaces and high street retail. They've set a goal of reaching net zero by 2030 by applying strategies to reduce the emissions from their buildings. So as you can see on the left, it's a strong financial company with a market cap of 9 billion and a current year growth estimate of 15.1%. On the right, you can see that they're strongly committed to ESG. They have a lot of different targets and goals to reach by 2030. For example, they have a 55% energy reduction of landlord and 45% energy reduction of tenant-controlled energy. And they've already started working on it and have great progress. They're also working towards waste reduction, and a lot of their offices already are powered by LED lights. So they're strongly focused on ESG, and they're a financially strong company, and that is why we included it in our portfolio. Moving on. Now that we've spoken about our portfolio, we decided to keep carbon offsets, as we believe that the net zero target for 2032 is ambitious, and these could help us offset the impact. As certified by the gold standard, they assure that our investment will lead to positive impacts for the climate, environment, and communities. And these are just not symbolic, but like real and verified results that we get with them. The carbon offset range for this is 32 to 50 per ton of carbon footprint, but for our analysis, we took a value of $50 per ton. And based on all of this, we move on to our returns breakdown. So we had an expected gross return of 8.1%. And after factoring in the carbon offset cost and the management fees, we came down to a return before taxes of 6.58%. In the end, we also did one risk and mitigations for our portfolio. As you can see the graph on the left, on the x-axis, we have the probability, on the y-axis, we have the severity. Starting with the COVID-19 outbreak, we think that with the new variants being less severe, the probability is not as high, but if it happens, it will also affect the companies in the portfolio a lot. Then the increase in carbon offset prices, we do not think that the probability of this is high, but we think it could be very severe. Increase in carbon dioxide from portfolio companies. We think that with the major commitments around the world, which have been there to move to carbon neutrality by 2050, we think that the probability of this happening wouldn't be that high, but it could be very severe for our portfolio. Interest rate risk, like we've been looking around, this is a big risk for everybody in the world. And so we think that there's a high probability of this happening, and it could be really severe. Geopolitics, we do not think that there can be direct confrontation between major world superpowers, but if it happens, it could adversely impact our portfolio. Regulatory risk in renewable energy, we think that there could be a probability of it, and it would have some impact, but not as severe. So with this, we come to the end of the presentation, and we thank you for your time.